All right, good Thursday afternoon, Finom Group members, investors, traders from around the world, our general YouTube audience. You'll have to forgive me today. It's coming. Started to get a migraine, and so it's hard to keep, full scope here today. For those of you know me, I suffer from migraines. Forgive my attire. I'm just trying to be as comfortable as possible. So we'll make this weekly state of the market as painful. I'm sorry, as painless. It's a tough one, folks. As painless as possible. We have a lot of quantitative data that we're going to go through here today. For our Finom Group members who are subscribed, if you're not subscribed, do so as early as possible. We got a great macro market weekly research report coming out Sunday. In the meantime, we're going to dedicate this video to a lot of quantitative analysis and studies, but if you're looking for some of the macro market fundamentals, our Finom Group members should scroll to the bottom where we include some of those macro fundamentals that we often talk about. For now, again, as painless as possible, let's dive right into it. As you can see here, midterm election years typically start to rally in the Q4 period, most notably on average in October. A lot of you already know this. We've looked at various different cyclical charts in the past. Ned Davis Research 4-year composite cycle index shows pretty much the same thing. And here we are. We're finally in the fourth quarter. We're in October. September is over. And what a September it was. We like to forget about it, I'm sure. We ended at the absolute low of the year and of the quarter. But here in October, the first 2 trading days of October look pretty darn good. In fact, we gained more than 5% on the indices, S&P 500, a little more than 5% in just the first 2 trading days, a 3% gain on, I think it was Tuesday, and a 2.5% or so gain on Monday, which fired a nice little breath signal, by the way. Anyways, all right, so this I found right here very interesting, and something that is part of my, I guess, investor makeup. We always hear this great colloquialism about, prioritizing risk management, right? I just don't follow that dogma as a part of my investing philosophy. I get it. Don't get me wrong. I'm not dismissing risk management at all. But it should not be number one on your list. And I often see people talk about it as if it's the number one priority. So reading this quote here from Chuck Yeager: hardest thing for most traders, investors to do is to pull the trigger and execute the trade. They put risk management ahead of risk taking, even though logic dictates there is no risk to manage absent risk taking. It simply sounds smart to speak of risk management and diversification, while the greatest returns come from concentrated exposure or concentrated risk. Just because he said it and you heard it doesn't mean it's right, practical, or highly profitable with a repeated return on capital. A focus on risk without a focus on results is doomed to fail the investor's objectives. It's, again, a lot of these colloquialisms that you hear thrown about, from very, talented and otherwise thought of leaders of the investing industry. They have no real logic to it. How can you manage risk that you don't take? It's chronologically impossible, right? But it sounds good. Anytime you talk about managing risk, it sounds like you're a disciplined investor. Anytime you talk about diversifying your portfolio, it sounds like you're a disciplined investor. But when we look at the actual results, a concentrated portfolio that takes risk, think about, look, I'm not a fan, don't get me wrong when I say this, but think about the ARK investment portfolio. You want to talk about concentrated risk? ARK will give it to you all day long. It's a very small part of the market that comprises that portfolio. And look what it did during the pandemic. Like I said, don't get me wrong, it needed the perfect environment. Again, no risk, no reward. No risk to manage. All right, let's move on. I really like this too. I found this from a friend of mine on social media, part of Market Scholars Group, David Settle. He's a certified market technician, great all around guy. And he had posted this the other day. I love it. This is the iceberg illusion. You see the success above water. That's what people see. And it looks easy, right? But here's all the stuff underneath the water to achieve the success. What people don't see, the bottom of the iceberg, that which is underwater. It takes, to be a successful investor, it takes dedication, hard work, discipline. You're going to go through various degrees of disappointment, sacrifice, even failure. But the savvy and the successful investor, they're persistent in these disciplines. You don't see it on a day in and day out basis. What we see are the results, but we don't tend to understand from what it takes other people to achieve those results. Oh, we'll get through it, but all right. Let's get into our first piece of quantitative data here. The S&P 500, after a down year to date to finish the Q3 period since 1946. All right, so going all the way back to 1946, these are the years that we've been down at the end of the Q3 period. Market rebounds. Now, you see that some of these are highlighted or shaded, I should say. These are all the midterm years. Midterm year, 1970, 74, 82, 90, 94, 2002, and this year is a midterm year. So you get, when you're down at the end of Q3, the next quarter, the average return is actually positive 3.1%. It's up more often than not at nearly 70%. The quarter after that would be Q1, not so great, 50-50. Next two quarters gets better. The next calendar year, 74% probability of being higher, and almost a 12% average return for almost 15% median return. But that's all of these years. Now we'll just focus on the midterm years, which are shaded, right? Because this is a midterm year. So when you're down at the end of Q3, the next quarter, which is Q4 during midterm years, has an 89% probability of being higher, average return 7.6%. Let's go out to the next year, right? Here's the year column. Again, just midterm years shaded in blue. I should have just read it. Almost 89% positivity rate. You go out next 5 quarters, 100% of the time the market has been positive. Look at the average return a year later, 19%. 19% over the next year. Now, here's something else. Market rebounds. The market rebounds 28.2% on average after midterm years are down. This is a down midterm year. So heads up there, folks. Let's see. So the S&P 500 closed September down almost 25%. The fourth worst year-to-date Q3 performance since 1930, which is not in here. This goes back to 1946. The record for midterm years down at the end of Q3 is strong, as we just discussed. We finished, and this is probably very important for you to know, so we finished at 35.85 on the S&P 500 at the end of Q3. We have an 89% probability of being higher in Q4 with an average return of 7.6%. Where does that take us to? Now, we don't know that we're going to get the average. That's why we, kind of lean into just the fact that we should be positive. So again, this helps you to manage cash and to look at any downside potential as a strong probability to achieve a gain by the end of this quarter into the end of the year. And again, the midterm years in this quantitative data from the Almanac Trader is shaded. Now, this study here is back-to-back S&P 500 gains of 2%, 2.5% or more. Remember, Monday and Tuesday, we gained more than 5% in those 2 days, back-to-back days of 2.5% gains or more. These are all the times that has happened going back to 1962. This is from Charles Schwab. So what did I do? I highlighted the midterm years because lo and behold, a lot of the years are actually midterm years. The bottom 5, 2002, and again here in 2022. Midterm years, I mean, that's a cyclicality working for you folks, showing that midterm years tend to have repeating human behavior engaging with price. So what are the results? That's, 1 week later, 1 month later, 3 months later, 6 months later. Now, 1 week later, mixed no matter whether it's a midterm year or not. 1 month later, there's still a lot of red here. 3 months later, look at the midterm year shaded. Only one time we were down, 1962, and it was down less than 1%. Midterm years. The other years, mostly 2008, have negatives 3 months out. Now look at 6 months out, not a single negative. We're never down 6 months out after we had this kind of a breath thrust. This isn't really a breath thrust that we're talking about. We're talking about a 2-day gain, a back-to-back gain of more than 2.5% each day. There is a breath thrust that I'm going to reveal and talk about in this weekend's research report that has a 100% forward probability rate for the next 12 months associated with those 2 particular days, Monday and Tuesday. So again, 3 months after you get a back-to-back gain like this, only once were we negative, less than 1%. 6 months later, positive every time. Will this time repeat? The fourth quarter strength? Maybe, right? Because based on the data that we just talked about, a bad September says, yeah, when you have a bad September, typically October is pretty darn good. 83% of the time, it's positive in October. Only time it wasn't. In almost any data you look at, 2008 is an outlier. Is 2022 like 2008? I guess that's what you have to ask yourself. I'm in the camp it's not, although it's not pretty. That's for sure. Down 25% and you don't have a recession. That sucks. But this is a derating cycle predicated on tighter monetary policy that is engaging or enacting, a fight against inflation. Let's talk about that for a second here, by way of a recent tweet that I tweeted, because we need to accept and understand what the Fed is doing and why they're doing it. Look, this is a fight against inflation, right? They know they can't do anything about the supply side of inflation, but they certainly can attack the demand side by making it harder, to buy a home with higher rates, to buy cars with higher rates, heck, to buy anything with your credit card because you now have higher rates on your credit card. So they're attacking the demand side of the economic activity equation. What is the other thing that they've been doing is every single Fed president that has come out and done their speaking engagements and interviews since the FOMC meeting has continued to say we don't have evidence that we've seen peak inflation or we've seen inflation roll over. Now, there's plenty of evidence out there, folks, right? We know that certain of the line items, certain of the variables constituting inflation in the CPI report, the Consumer Price Index report, work with a lag, like rent, like housing, even used cars. They work with a lag, so they're not showing up to the magnitude that we had understood they should, eventually creep into the Consumer Price Index. And the Fed is well aware of this. They're not ignorant of it, and yet they keep saying we don't have evidence that we've hit peak inflation yet. So we have basically fully intend to continue hiking rates. They're not ignorant of the data. They see the high frequency data the same as you and I. So why do they keep with this message that we don't have evidence we've hit peak inflation? Well, the reality is that they don't want. One of the ways to fight inflation is to fight the demand. And in order to do that, you've got to fight the wealth effect, right? They went after housing. One of the biggest wealth effect potential that a household has is the appreciation of their dwelling, of their home, right? They can borrow against it, and it just makes you feel wealthier when your home is appreciating. Well, home prices stop appreciating in July. So that they're attacking that wealth effect. The other way, the stock market. If your 401k is climbing, don't you feel wealthier? Don't you feel like you can go out and buy that extra shirt? So the Fed needs to attack the wealth effect, to basically, also be attacking the demand side equation. So that's why they keep with this dogma, if you will, of we haven't seen peak inflation. We fully intend, to continue hiking rates into restrictive territory if we have to. Right? It seems like they're not connected to the on the ground data surrounding inflation, but the reality is they know what they're doing. They're doing this on purpose. They know their message is powerful, so they can keep a lid on the stock market, keep a lid on housing prices, and therefore keep a lid on inflation. All right, back to business here. Let's see. Only 2022 was the worst start to a year for the S&P 500 since 1974 and 2002, as shown in this data here. 1974, we were down 32%, basically to end the third quarter. 2002, down 27.9%. You have to go all the way back to 1931 to find another date, but we're dealing with the post-World War II era. So, this is the worst start to a year since 1974 and most recently 2002. Now, here's the funny thing. Here's a chart of 1974. Notice where it bottomed. September 30th is where it bottomed. Here's another one. That was 1974, and this is 2002. Look at that. The bottom was the week of also September 30th. Both of those weeks. Isn't that remarkable? And again, both of these, 1974 and 2002, were what kind of years? Midterm election years. All right, we'll move on. Percent of stocks above their 50-day moving average. We've talked about this endlessly. Hit 90% on August 12th. And then we had a complete reversal. I mean, just last week, less than 3% of S&P 500 stocks were above their 50-day moving average. Just basically completely wiping out, and failing to achieve the 1 month, the 2 month, and 1 month, because the S&P 500 was at 4280 on August 12th. So 1 month later would have been September 12th, and we were only lower. We had a 67% probability of being higher, and we didn't achieve it. 2 months later, which would be October 12th, we've got an even better possibility of being higher at 72%. But again, we got to get to 4280, folks. It's not looking likely. The good news, give it more time, 3 months, 6 months later, in the post-World War II era, so since 1947, only down once 3 months later. 6 months later, same thing, only 1947 after this breath thrust. 1 year later, positive 100% of the time. Average return 21%. We talked about the put call ratio a couple weeks ago, skyrocketed. It went up to 1.36. Now, this is the total options put call ratio getting above 1%. The last time it did that was late August. And the 10-day moving average was also above 1%, first time since the June lows. The June lows. Now, we also had a study, attached to the put call ratio getting above 1%, 63 days later, right? So that's three trading months later. The average, every time it was positive, the S&P 500 delivered a positive return every single time. The average return was 11.82%, but in between that average return and that 100% positivity rate, look at the average drawdowns, almost 8% on average. And, when you get these kind of levels in the put call ratio, usually bad things have been happening in the market. Here's 2008, here's 2020, bad things were happening in the market. This study only goes back to 2014. If you went as far back as 2008, you'd have drawdowns too. Nonetheless, positive returns 3 months later, every single time since 2014. And it included the bear market of 2018, included the bear market of 2020. There might be some pain before you see these gains. All right, so why all of these folks are buying put options, right? Because it's the put call ratio. They're buying a lot more puts than they are calls. Retail option traders are in a put protection frenzy. Look at this, folks. I mean, this is basically the highest since the turn of the century. Nearly 18 billion spent buying put options to open as of last week. What's interesting is you get the exact opposite situation when it comes to corporate insiders, which have been selling at the least amount since basically 2012. They're not selling the market. And if they're not selling, what do you think they're doing? So whatever these folks are selling, these folks are buying. It's an interesting dichotomy in this environment. One of the other things we've talked about so far as the put call ratio is concerned is the 5-day moving average of the put call ratio. This is the equity only put call ratio, not the total options put call ratio. It's important to make that distinction. This is the equity market put call ratio. And we can see, from 2020, down to 20, we were buying calls hand over fist. That's why you have the downtrend here in the put call ratio. Less puts were being bought. We kind of went sideways here through 2021, but now look what's happening. They're buying fewer and fewer calls. They're buying more and more puts. So you have this uptrend in the put call ratio. This is like sentiment. Here they were buying calls hand over fist, market going higher. Here they're buying puts hand over fist, market going lower. You have this mean reversion in investor sentiment. But when the 5-day moving average gets above 0.75, and it's gotten to 0.80 now twice this year, you're usually putting in a bottom. In fact, since 2004, if you bought equities, or an index ETF, if you bought the index ETF when the equity put call ratio was 0.75 or better, the market was positive 6 and 12 months later every single time. The bottom was in hindsight. So again, people always talk about capitulation. This is a form of capitulation. You get the put call ratio at these levels and the 5-day moving average of the equity put call ratio at these levels. it's a sign of capitulation. I mean, the sentiment is just that bad. Investors are just that defensive. There's nobody on the other side of the boat. All it takes is a spark. You get a short covering rally like you wouldn't believe. And I'd be of the opinion that some of this recent rally was a short covering rally. Not all, but definitely some. We've talked about this chart time and time again, just putting it up there, making sure it's front of mind, because there's this dogma out there, right? What about the Fed? What about the Fed? Folks, this goes all the way back to 1942. Midterm seasonality, S&P 500, November election through April of the following year. It's never been negative. Here's your average returns. Pretty darn strong, 17.2% on average, front of mind. But we can narrow it down even further, right? Because I was actually asked, what about November through the end of this year, right? Of the actual election year? It's a good question. Because quite frankly, the results are not as strong. Here it is, election eve. So the day before the election through year end, you've got only a 2.6% average gain. 2.6% average, and you see a lot of negative signs, right? You do see a lot of negative signs. They're not bad. I mean, 3%, 1.5%. This one's rough, 1974, 6.2%. They're not terrible. And you still are up more often than not, obviously, with a 2.6% average gain. So that helps you to narrow it down. Again, this is for game planning. How much cash do you want to remain with on the sidelines, starting election eve through the end of the year? Maybe you dedicate, 10% of your cash to start allocating on election eve. And then maybe, before the December holidays, right before Christmas Eve, you go full bore anticipating, the rest of that January through April time period. These are the best 6 months to own stocks in history, folks. Since 1950, the best 6 months to own stocks is November through April of the following year. There we go. And again, here's S&P 500 index price return 1 year after midterm elections. The market has never been down. Never. We talk about seasonality, and I hate that term when it comes to fund flow, because that's essentially what we're talking about. When we look at seasonal patterns, cyclical patterns around midterm years, you have to recognize that it's actually fund flows. It became this, it's labeled as seasonality, but I think that kind of denigrates or dumbs down the reality of the situation, is that there are scheduled fund flows for whatever reason around the midterm year into year 3 of a 4-year presidential cycle. And again, think of it, if you think about it in those terms, right, and using a metaphor of the schedule, these are scheduled fund flows. Why is the fourth quarter of the year usually the best quarter of any year? Because September is the fiscal end for many companies. And when it comes to 401k management, they start their allocations in Q4. It's fund flows. It's a schedule. You're scheduled to go to work. It's not seasonality for you, right? You go to work because you're scheduled to clock in. It's the same thing. Never a down year, folks. The worst stinking year was 1986 and 1987. The worst return a year after midterm elections. You probably heard, what is it? Sell Rosh Hashanah, buy Yom Kippur. And there's a lot of good, details. This one happens to be just the midterm years for that saying. Sell Rosh Hashanah. I hope I'm not trying to offend anybody if I haven't said that right. Buy Yom Kippur. So forgive me. But these are the midterm years. And again, this saying is for all, years, for Rosh Hashanah and Yom Kippur, but I wanted to extrapolate the midterm years from the Almanac Trader. And as you can see, I mean, they're almost all positive. Only 2 times was it down for this, this time period for capital allocations. And the thesis for this sell Rosh Hashanah, buy Yom Kippur, is folks sell positions on Rosh Hashanah, first of the days of awe, to rid themselves of financial commitments and then return to the market after Yom Kippur, the Day of Atonement. It is no coincidence that this coincides with the seasonal September into October weakness, because there is the first part of October tends to be pretty choppy, if not weak. And once you get into the middle of October, you hit your stride. And we're not just hitting the stride once we get into October, but we are in the sweet spot for historical returns. The weak spot is midterm, Q2 of the midterm year through Q3. And right, it didn't disappoint this year. But the sweet spot is Q4 of the midterm year through Q2 of year 3 of a 4-year presidential cycle. The best absolute returns of any cycle are in that 3-quarter period. And you know the deal with returns in the 3rd year of the election cycle, going all the way back to 1931, only down once. Yes, 2015, the market was down around a little less than 1%. But if you include the S&P 500 yield, you are actually positive. Only down once in a, that's not coincidence. But that's why I say it's suggesting the word seasonality to label how strong in the positivity rate around this upcoming cycle doesn't do it justice. It's scheduled fund flows. All right. Well, we get into some fundamentals here, but I got to cut it short. I did my best to get through this week's State of the Market, folks. I hope you enjoyed it. If you're not a subscriber to Finom Group, we hope that you subscribe today and take part also in our weekly macro market research report. Until next time, safe trading, everybody.